we're getting the technology switched over here to the next talk, let me just tell you what the motivation was for it. Every year we hear from one or two of the senior fellows and of the organization, and they talk about what they're thinking. And Andrew's talk was absolutely terrific in terms of what he's thinking about. And after lunch, we'll hear from Dr. Simons. And what I did for this talk is I went and talked to all the other senior fellows and to the board of director members and asked them, you know, what are you thinking about? What do you think are the next great questions that we should all be focused on right now? And if you had to pick a single most important question that's facing you, what's the deepest question you're thinking about in finance? That's, in fact, what we're going to go through here. In order for me to do that, and let me just say that it's been absolutely fun to put this together because some of the questions I think are pretty neat. How do I have to put this forward off the laptop, or is the button?
What's the other one?
The
Laptop's on the other side.
Oh, it's on the other side. Okay. Get the technology down. I don't think so. Maybe. I know. I think I need some. The which one? This laptop. Okay. The third laptop. Okay. I just want to set just a touch of a historical context. You know, it was really only 25 to 30 years ago that we were in the middle of this particular diagram, which was really deregulation of rates and currencies. You know, we got our first interest rate volatility, our first currency volatility, at the same time the first models, the Black-Scholes models, and we started to look at things like spreads and zero coupon bonds. And for those people who were in the room, and of course 25 to 30 years ago, those of us on the board just want to say we were all in kindergarten at the time, but we were drawing boxes and arrows like crazy, you know, which you see sort of in the upper part of that to really talk about what was the early genesis of swaps. And it was against that background that the IAFE was actually founded. It was founded in 1992. And I thought it would be fun just to give you a quick and very, very fast tour through what we've looked at in these conferences in the past. We actually started out very much on the tutorial side, teaching people the ABCs of what are swaps, what are mortgage-backed securities, how do you think about the knowledge base of the financial engineer. What is it that everybody has to know how to understand to be able to be a financial engineer? And the other thing that was interesting is it had a huge liability focus. We were actually looking at what we thought were the deepest problems at the time, and those were in the area of the thrift crisis with the Resolution Trust and in the area of pensions and asset liability management. As we got into the topics of the 1990s, we added in quite a few things actually to what we were starting to think about. The first thing that we did was we actually said, you know, in the upper right-hand side there of this chart, we actually had an imbalanced market. Once we figured out what all the problems were that were facing people like the thrifts, we had a one-sided trade. And we really went out and started thinking about who are the people that should be on the other side of that trade. And the people who should be on the other side of that trade, it turned out, were a lot of corporate America. And so the next few conferences we had were very focused on bringing those groups of people into the world. We also started to take a look at some things that were happening. As all financial markets, we had some losses. We said, let's go study those and figure out what's happening. We added in pretty quickly from there that we needed to have some technology underneath this. After all, we'd had the advent of the personal computer. We started to have data series. We started to be able to study things even better. And along with that, we started to get the early internet and things, and we got a convergence a little bit between technology and financial engineering. We progressed from there in the organization to actually looking at some portfolio level questions for the first time. Much before that, it was really a very instrument-based focus in this organization. And then we started to add in the math. And this is several years in. So we started with the math, went away from the math, tried to figure out the end users, brought in a little bit of the regulation, and then we brought back in some of the math again and started in with value at risk and Monte Carlo simulations and a few other things. When we hit the 2000s, the first thing that we did, and you see here for the first time the asset side coming into the ball game. Before that, we were almost exclusively liability and asset liability management focused for the thrifts, the pensions, and the banking community. We brought in the asset managers, and we started looking at things like e-commerce, and also you see for the first time things like financial litigation. I don't know if, for those of you who want to take this little trip down memory lane, that at this point is really within the last 15 years, there was quite a lot through the 1994-1995 period of derivatives being on the cover of every major financial magazine. You know, the risk that won't go away with shark covers and actual hearings in Congress on derivatives. We got into focusing a lot on taking it into emerging markets. We started looking at alternatives. We also added in an overlay now, along with the technology, of focusing on operational risk. And after that, we actually started into the institutionalization. We focused a lot on alpha, beta. I put schmalpha up here just because people started saying maybe we're getting a little too over top with the numbers and we're not looking at more of the practical side. And we started really thinking more, again, on the asset side about asset allocation. So this is all just derived from this same conference that we've had now for quite a few years, since 1992. Came sort of at the end in terms of looking at challenges for hedge funds, at valuations. There's something on that again this afternoon. What happened is this has really been a cycle in setting the stage. Since we founded the IAFE, you know, we started with a lot of specific instrument focuses. We moved on to a big liability focus. We got into the portfolio management questions of how do you put all those instruments together. Then we said, wow, we better look at this operation and technology, because it's at the absolute root of what we're all doing as financial engineers, and it's critical we understand that. And then we added up the asset side. Along the way, being the financial engineers that we are, we invented a ton of interesting products to fill gaps on things that people needed. So that kind of brings us to the present of, you know, what are the rest of the senior fellows in this organization thinking about? You know, the roster on the flagship here is quite incredible. And so in talking to all of them, it was a very lengthy list. What I'm going to try to do here, and it's not a complete list, is just give to you what some of the main areas are that they're really thinking about right now. So first I'll go to the micro side. And I'll just say that on the bottom line, model questions remain. The first one, why are prices so noisy? You know, why is it that what we're doing in models really are still only explaining a fraction of the return? Perhaps it's the behavioral piece. Perhaps it's other things that we haven't discovered in terms of the limitations of the math. What causes the price momentum? How can we model it? So certainly there remain questions on the micro side that started out the beginning of the organization. On the macro side, however, this is an area where I have to say there were loads of questions by both the board members and by the financial engineers. Also, if you look at some of the work from the Financial Stability Forum that's just out, and some of the things that the IMF's coming to town next week to talk to folks about, how serious is this lack of transparency and exposure through things like complex credit derivatives and the systemic risk from those? Also along those lines, how will all of the financial engineering and the correlation assumptions embedded in the CDOs and the CDS hold up in times of stress? You know, with credit spreads so tight, so much liquidity, there's a lot of people thinking about, you know, just what's going to happen and how does it all fit together. Another version of that that is a very interesting question. Think of in a trading system that someone's made, a rule that they say, I don't want to ever control more than 5% of the liquidity of a stock. I would argue that we could find at least 50 people who all have that rule. And I think the question is without information from others, how do you know what happens when you compound that? And you take those rules that each individual is making quite prudently, but you think about there's a lot more people that add up to a lot more than 100%. And another variant on that is that mark-to-market systems are very much based on the same technology, and the aggregation is clearly nonlinear. I don't think anyone would argue that it's a linear aggregation problem. Accounting systems are static. Risk is not static. This is an area where I have to say there are at least a half a dozen of the senior fellows posing, I think, some pretty interesting questions, and I suspect this is a place where we'll hear a lot more in what the IAFE's activities are going forward. This is another one that actually was, I have to say, probably on the definitely in the top 3 of areas people are thinking about. It's the pension problem. How are we going to fund the retirements of all the baby boomers that are going to live a long time? What's the proper framework to gauge this problem, and how large will the asset value adjustment be? To put that sort of driving it home, if everybody who's in an aging population is having to liquidate assets in order to pay for living for those extra years, how much will that adjust prices? If everyone's selling their portfolio at the same time, their houses at the same time, if they're trying to get very liquid at the same time, you know, when you look at the actual movement in the overall prices that occur, it could be pretty significant. And I think we actually have quite a lot of people starting to think about that. The pension fund debate, when will the U.S. catch up to the U.K.? You know, Lord Turner, Adair Turner, did a wonderful study by the U.K. government a couple of years ago, and the pension problem's really been on the front page press in a lot of Western Europe, but we haven't seen it so much over here yet. And the question is, you know, how are we going to get at that problem and see how big it is? How can we help individuals to manage financial risk better in the context of that? Now, this picture is courtesy of Andy Lowe, who just gave a terrific talk on the behavioral finance side. I'm going to put a little bit of a different twist that came from one of the other senior fellows on it. So we have lots of examples of individuals making suboptimal choices in the face of uncertainty. When you look at the math versus what you look at what the actual behavior is or the price behavior in the marketplace. And this one, I thought this was just a really special question. Can and should people be reprogrammed to make the proper wealth maximizing choices? It's kind of the other side of it. Okay, if we see that people are doing that, maybe we should keep the math and change what the people are doing to trade that better in the marketplace. And how quickly could we actually do that? This one was also an interesting question that I really felt compelled to put up here. Do we have some discrimination against financial engineers and the mathematicians? I mean, why is it that some in the press and some people in the investment community are so negative on models? You know, there's certainly an increasing portion of the markets that are traded with quantitative techniques, and this question came in many variants from the group. The argument at the core of it being that actually it's the proprietary trader who's the black box. It's the proprietary trader who you can't get in the head of to know what they're thinking as to why they're selecting to go long or short a particular instrument. And then in fact on the quant side, because it's much more systematic and because you can actually explain why someone's going long or short, that's not the black box, it's the other way around. And there was actually a lot of suggestions that this is a place where the IAFE itself should do a fair amount of education. A lot of excitement still, and looking forward, you know, sometimes when we do our a day in the life of the quant panels and we bring in the students in the financial engineering programs who always want to ask the question, wow, everything exciting's already been done. You know, what are we gonna do? You guys got to do all the fun stuff that happened, starting with drawing the boxes and arrows in Swapland back in the early 80s. And I think the answer here that a lot of the senior fellows are coming up with is that we still have some pretty big territories that we haven't tackled. Here's one example: how fast and how extensively and in what form will the capital markets-based solutions be extended to traditional insurance? You know, insurance, when you actually look at it, if we start to spread that through the markets and turn it into the derivatives on insurance, is probably as big, if not bigger, than the interest rate markets were. So this should be a pretty exciting time yet again. I had to put this one in because we do have, since we've brought in a lot more on the asset side into the marketplace, investors have asked this question. There is tremendous liquidity in the alternative asset space, and especially in hedge funds and private equity. Returns will erode, and we will need to ask ourselves whether these alternative asset classes are still worth the 2 and 20 that we pay for them. So the investors took a shot here. It's certainly, you know, a big question about where fees will go, but one that actually was on more than one list of people. I have to give the practical award to this one, and perhaps this speaks a little bit to the life cycle maybe of our senior fellowship, or maybe of those of us on the board of directors that, we used to be thinking about all these really big problems about, asset liability management for the entire pension industry or for the thrift industry or for the banks, or how do we solve this problem for corporate America. Now it's getting really personal. Actually, when I put it all aside, and what was brought out by the senior fellows who put this one up is when I look at my own portfolio, I still don't have the answer for myself here. How should I make my own financial decisions in terms of pre-retirement? How much should I save, invest, and insure? And post-retirement, how much should I spend, invest, and do something like annuities? And so clearly there's a lot of work that people are feeling needs to be done even on the most basic levels. So what I just want to conclude this part and say is that this organization, which has been around now for quite a long time, is at a very interesting time. I mean, if you think back to that life cycle chart that I did, I mean, we continue to do a lot of work with the financial engineering programs. When we started it, there weren't any. Now there's over 60 around the world in terms of financial engineering programs, from the University of Beijing to INSEAD to the LSE to MIT to Stanford and Berkeley. And as we come out, there tends to be a lot of both micro-based questions, macro-based questions, individual questions in terms of our own portfolios, things in the market. There's some new frontiers here that everybody thinks are exciting. So I'll just close actually with a bit of a commercial, which is to say that within the IAFE, the board right now is taking a pretty serious look at where we want to embark on our next strategic directions. Certainly the senior fellows here have put up quite a list of pretty interesting questions from, on the modeling side, how do we get our models to work better, to on the behavioral side, how do we marry, the failures of mathematics to, what the actual experience is in the marketplace, to looking at some of the next big frontier problems we're facing, from the pensions to getting insurance risk better distributed through the systems. And I think that's one thing we have to encourage all of you as members of the organization and people who are coming, obviously to these conferences to hear from us, what directions do you want to see us head, because the topics now are so immense, whether you want to look at the operations, the technology, the mathematics, the modeling, the trading side, and on the asset side, the liability side, the asset liability problem, that we could sit here quite handily, I think, on a weekly basis on all those topics. So we encourage you to send us your feedback on that, and I'll wish you all a great lunch. You're going to make a couple of comments, David, for lunch? Okay.
A couple of brief comments. I made this announcement before, but I know my mic was turned off. The last chance for the hedge fund valuations poll, which will be for the 4 o'clock panel. If you have not completed this, I would like to, please turn it in at the front desk. We will reconvene at 2:15 for Jim Simon's keynote speech this afternoon. I also want to make a quick announcement and thank our sponsors, who all have areas outside: Carnegie Mellon, FlexTrade, the MFE program at University of California, Berkeley, Tethys, and Wilmot's Certificate in Quantitative Finance, 7 City. So thanks very much. Enjoy lunch, and I'll see you at 2:15.